All right, so this video is going to focus on a problem from the chapter 2 study materials. Example number 2. Now, in these study materials, there's a lot of examples, and I do suggest certain ones in the course schedule. For example, example 1, it's a great problem. It has different types of adjusting entries, lots of different ones. And so this is kind of just an individual one adjustment at a time, kind of very vanilla from the notes, allowing you to practice different types of accounts, different sorts of adjustments. Then what follows is a sort of battery of these questions where I give you an unadjusted trial balance and then additional information about different accounts up in this balance that need adjustment, and then ask you to make adjusting entries and closing entries. And there's at least three of these in particular that start with an unadjusted trial balance. I would really make sure you practice all three of them. Two of them have an accounting period of a year, one has an accounting period of a quarter. And then there's another one similar to these, but instead of an unadjusted, it provides an adjusted trial balance. And so there's different versions, right? Once you start getting familiar with that, what I suggest is working one without notes, and I'm sorry, one with notes, where you're referring back and trying to learn what to do, and then doing a second one without notes so that you can see, well, what did you retain? What do you still need to work on? So let's focus on this one. Whenever you're doing one of these problems, it is paramount that we know exactly what step of the accounting cycle we're on. This is an unadjusted balance, and so this means that we're at step 3. And we're at this step at December 31st, 2020. Now, the second thing that is crucial to even starting is knowing how often the accounting period is that we're adjusting for. Do we want a full year? Do we want a quarter? Do we want a month? All of those are perfectly valid accounting periods and will change the math slightly. So, in this case, the very first statement tells me it makes adjusting and closing entries once a year, each year at 12/31. So this means that we have an annual accounting period in this scenario. That means all of my adjustments that these accounts have not been adjusted. So the last time we did step 4, last time the accounts were adjusted was 12/31/19. And that'll be important, in understanding how many months we're adjusting for in each account, some applicational questions. And so we really need to get that first. Since we're at step 3, that means that these accounts have been updated with all of the transactions that occurred between 12/31/19, basically January 1st, 2020, and December 31st, 2020. So all of the transactions that happened during that year are already embedded in these accounts. What we have to do now is pick up at step 3, apply adjustments where necessary, and then apply closing entries. So in order to make the adjustments, we need the extra information. This, these bullet points down here all highlight different facts about the company and the accounts we see up here that will allow us to determine what sort of adjustments need to be made. The first one is talking about the building account. It says that the building has no anticipated salvage, which just means that at the end of the building's useful life, the company does not have an estimate of how much it will get for selling the building for scrap or just, selling the building off. It has an estimated useful life of 20 years. So the useful life of 20 years tells me that the company believes that they will use this building for 20 years and generate revenue from it. So how are they generating revenue from the building? Well, I mean, it's not direct, right? I mean, they're not necessarily renting it out or, getting money from other people occupying it. But I mean, we need a building to base our business out of for our employees to gather and do work, right? For our clients to come and buy our services. And so in that way, the building is generating revenue for 20 years. So what it wants me to do is to provide the adjusting entry at 12/31/20 and determine the date of the building's purchase. So I need an adjusting entry. All adjusting entries are made at December 30, at the end of the period that we're talking about, in this case, December 31st, 2020. We're wanting to depreciate the building. And remember, when we're depreciating the building, we're just applying the expense recognition principle and recognizing an expense in the periods that we use that in the periods that the expense we're recognizing helps generate revenue. Well, in this case, we had a $1 million building at some point. It cost us $1 million. We know because we record PP&E assets at their historical cost. So we spent $1 million for this building, but we didn't recognize any expense for it, right? We debited building, we credited cash. We're not recognizing that expense of $1 million. We want to match it to the revenues that that asset will help generate. So I spent $1 million, but spending that $1 million will actually benefit my company for 20 years. And so if I use straight line, which is the only type of depreciation I'll ask you about here, then what I'm saying is if I divided this $1 million building's cost over 20 years, how much expense of this 1 million should I recognize every year? And we get $50,000 per year. So that's the amount of depreciation expense I want to recognize here. The credit account would be accumulated depreciation on the building. If you have multiple fixed asset accounts, it's a good idea to use the hyphenate to identify where the accumulated depreciation is going for bookkeeping purposes. We only have one here, but it's just an old habit I've developed. Now, what is this accumulated depreciation account? Remember, this is a contra asset account. So it's not an asset, but it's close to one, right? It's actually opposite of an asset. So if I have my accumulated depreciation account and I make it to a T account, we can kind of see what's going on here in terms of what this is doing and what a contra asset is. Remember, contra assets have the opposite balance of their parent account. So instead of a debit balance, it's opposite of the asset. So it has a credit balanced account. Credits increase this account, so we're increasing the accumulated depreciation. Now, when I draw a T account, just so you understand the formatting I use, I only use the horizontal lines when I'm coming to a trial balance amount. So in this case, the 300,000 underneath this represents an unadjusted trial balance. I don't really know where it began, the period at. I don't know what its 1/1 balance is. It could have been 300,000. It could have been more than that, right? It could have been whatever. I don't know exactly what happened during the period to get me here, but I know that my unadjusted trial balance is this. Now, I credited this account by 50,000, and that adds this 50,000 into my ledger account. This is the adjusting entry. And that results in a $350,000 adjusted trial balance. So even though it seems overkill for such a simple problem, and I didn't even ask for a T account analysis or what the adjusted trial balance was in this particular question, I wanted to show you this as a sort of, scaffolding for how I do things in upcoming lectures or how my keys look. This process is very important. And as I said, it seems so simple, but a lot of times people will get the adjusting entry versus the adjusting balance confused, especially in more complicated transactions. So just adopting this real quick out the gate is a great starting practice. Now, I need to also identify um, what debiting this account does in terms of financial statement effects, what crediting this account does in terms of financial statement effects. Any expense, right, is going to be a net income effect. And because it's an expense, it's going to reduce net income. Now, it's going to go on the income statement. Sorry, it's kind of obvious. Oh, I assume that's obvious because it affects net income. Now, the accumulated depreciation building is a contra asset. It reduces assets on the balance sheet. As it grows, it reduces them further because we subtract this balance, which grew from 300 to 350, from my building's historical cost to get its book value. So the more I'm subtracting from 1 million, right, 350 rather than 300, it's going to reduce the net asset that I report on the balance sheet. Now, using this information to determine the purchase date is a bit of an applicational question. Um, this is probably maybe worth 2 points. It might even just be pure bonus. So it's not a whole lot. Whereas this whole entry, together would probably be about 7 points of credit. So if this next part confuses you, don't worry overly about it. Do try to understand it, embrace it, figure it out. But if it just seems too much, then it's not going to like ultimately kill you on the exam. Um, so in order to determine the purchase date of the building, the way I go about it is to consider that if $50,000 is being added to this account every year, then this represents $60,000. I'm sorry, 60,000. This represents 6 years. So 300,000 divided by 5 year or divided by 50,000, my depreciation per year gives me 6 years. Now, the question becomes 6 years from what date? Because a lot of people will take the 6 years, subtract that from 12/31/20 and say, oh, well, the building was bought 12/31/14, which is close, but not quite. And the way to really understand that is to consider, is this the balance at 12/31/20? No, because it hasn't been adjusted for the year 2020. This is the depreciation expense for the year 2020. So this is the true balance at the year 12/31/20. 350 divided by 50 is 7 years. And if I take that appropriate one and subtract it from 12/31/20, then I get that the building must have been purchased on 12/31/13. Okay. And that is the correct answer. Well, what about the 6 years? Like, well, how does that work? Well, if this was the balance at the end of the prior period, then 6 years from 12/31/19 would still be 12/31/13. So basically, you can get it either way. You just have to know what this number indicates in terms of, is this the value at 12/31/20? No. This is the value at 12/31/20. All right. The final piece that I ask on these questions is whether this entry is an accrual or a deferral. And that's down here. I'm going to make just a couple of notes about those real quick. I talk about these in the lecture notes. It's about the timing between cash and the recognition of revenue or expense. If we're talking about an accrual, we have the revenue or the expense recognized first, and then later we either receive or spend cash. So basically, we recognize an income element before we get the cash under an accrual adjusting entry. Under a deferral adjusting entry, the receipt or spending of cash precedes the revenue or the expense. So we get the cash first, then we recognize the revenue later, or we spend the cash first and recognize the expense later. In this particular example, there's really kind of two answers. We definitely bought the building some time ago, clearly 12/31/13. So the expenditure happened in the past. We're still recognizing expense. That aligns with a deferral. We deferred the expense, even though we bought the building on 12/31/13, we're still recognizing the expense later in time, deferring it, right? Other people will just call this an estimating entry or an estimate. Okay, there's a lot of estimates and adjusting entries, so that is almost its own classification. But this one in particular also bears or meets the criteria of a deferral. All right. The next one we need to look at is the prepaid insurance contract. So it reflects 18 months of the remaining contract and was originally paid for in full during 2019. Provide the adjusting entry at 12/31/20. So we need to adjust this prepaid insurance contract. We bought it in 2019. The $24,000 represents 18 months, it said, right? That balance reflects 18 months of the remaining contract. So if I take this 24,000 and divide it by 18, and be sure to keep track of your units because I'm going to divide it by 18 months. And that's going to give me 1,333 and 33 cents repeating. Okay, for me, you can, as long as you show me your work, you can round to the nearest dollar all you want. I am not a fan of carrying cents forward, so yeah, 1,333 would be perfectly fine. But remember, this is per month. Now, how many months during 2020 did we use this prepaid insurance? Because we're only worried about 2020 now. Anything that we use in 2019 has already been taken off of this number because we would have adjusted it off in 2019, right? Reduce this account for what we used up. So we're really concerned about how much did we use in 2020? Well, if it was paid for originally in full during 2019, then that means it was in existence on January 1st, 2020, and that we've used it all throughout 2020. So that's all 12 months. And when we multiply the per month by 12 months, we get that for the full year, we have used up $16,000 of the prepaid insurance contract. We have to recognize the insurance expense for that because when we paid for this prepaid insurance, we just debited prepaid insurance for the full amount that we paid and then credited cash for it. We did not recognize an expense. By the expense recognition principle, we want to recognize the expense in periods that benefit from the cost. Well, 2020 benefit in that we didn't have to make an insurance payment because we had already made it for a number of months that covered the entire year of 2020. So this expense is recognized as we're using that up. And then I credit prepaid insurance for the same amount because I have less prepaid insurance now than when I started. The expense similarly reduces net income. The credit to prepaid insurance reduces assets. And now we just have to decide whether this is an accrual or a deferral. Now, remember, in this case, it's about where the cash fell. Did the cash come before the revenue or expense, or is the cash coming after the revenue or the expense? We're recognizing expense on 12/31/20. When did we buy this? We bought it in 2019. And so the cash came first in 2019, and then I'm recognizing expense as I use the duration of that contract. All right, the next one deals with the note payable. So we got a long-term note payable of 200,000. It says the note payable was issued on September 1st, 2020. All right, so this is different than the insurance one because the insurance was in existence on January 1st, 2020. This note did not come into the company's life until September 1st, 2020. So we're not going to need a full year. We're going to need less than that. It bears an annual stated rate of 4%. The parenthetical note tells me about the market rate and that the note was issued at par. You can disregard that. Basically, it just makes the interest entry a little easier. Interest is payable on August 30th of each year. Provide the adjusting entry at 12/31/20. So what we got here is basically, I'm going to draw a timeline where on 9/1/20, we borrowed money. So we borrowed money and signed that note. A note is really just a loan. Okay. We're now adjusting at 12/31/20, and the first payment isn't going to be made on this note until 8/30/21. So we're going to pay a full year's interest on this date in cash. So the cash payment for interest is due. Not the note itself, but just the cash payment for interest. Now, even though we haven't spent any cash at 12/31/20, we still have had some time pass here, right? And how many months? We have September, October, November, December, 4 months. Use your fingers. There's no shame in it because many will just subtract 12 and 9 and get 3, but there's actually been 4 months here. 4 months of interest. Even though we haven't paid it, we still have to recognize that. And that's what our adjusting entry to interest is going to do. So in order to calculate the interest, I take the amount of principal and multiply it by the annual stated interest rate. So this is an annual rate, which means that if I do this product, I'll get 8,000, but 8,000 is a full year of interest. Do I need a full year? No, I don't. I'm only up to this point in time. So I only need 4 months. If this is a full year of interest, then I can divide it by 12 and then multiply that result by 4. And that will tell me the amount of interest expense I should recognize this year. It comes out to 2,666 and 66 repeating cents. So I'm just going to round it to 2,667. And then we make the entry. So be careful with notes because when we recognize interest on notes, we debit interest expense and we credit interest payable, right? Basically, we're creating a payable account that tells investors on 12/31 they might not have paid it yet, but they're going to have to pay at least this much interest that is accrued over these 4 months. And just as a side note, just to get more familiar with the lingo of accounting, when someone says, "Well, the expense was accrued we accrued the expense," what they're saying is they recognized the expense and then they added it to another account, accrued it into this payable account. 2,667, 2,667. Expenses appear on the income statement and they reduce net income. A payable is a liability, and if we credit liabilities, they increase liabilities. So now all we have to do is determine whether this is an accrual or a deferral. So we're recognizing an expense here. We're not going to pay the cash until the future. That's an example of an accrual. Yeah. All right. The next one, we have a deferred revenue account. Right? Deferred revenue. Remember, that's the same as unearned revenue, just the more common name to use in practice. $40,000. Suppose that this represents gift cards purchased throughout the year. So when someone buys a gift card from my place of business, what they're doing is handing me cash, but I have not performed a good or service yet. I've just given them the gift card. But as I've issued that gift card, I now have an obligation that when that gift card comes back, I have to perform a good or service without being paid. So that's going to be recorded at the gift card's purchase as a debit to cash and a credit to deferred revenue. When these are redeemed, though, someone brings them back, right? Well, they brought them back, so we don't have an obligation anymore. We can reduce that obligation as the cards are being redeemed. But then we provide the good or service. Now we've recognized both parts of revenue recognition. That's the adjustment that we need to make here. We get to recognize revenue for the cards that are now being redeemed. So, as I mentioned, the cards are coming back. I no longer have an outstanding obligation to 20,000, the ones that were redeemed. And when they're redeemed, I have to provide a good or service without payment. So rather than payment, I already received the payment, right? Like before this, like way, I don't know when exactly, said throughout the year. But basically, I got cash and then I had to record it as deferred revenue for the full 40. So this is not the adjusting entry, but this is an entry that must have happened during the period. So the cash was originally recorded as deferred revenue, but once the deferred revenue has been, once the card is redeemed and we provide the obligation, the obligatory goods or services, then we can show that we've earned revenue from the cash that was paid at some point during the period. Because it did say um, the deferred revenue account represents gift cards purchased throughout the year. Okay. So deferred revenue is a liability, and that's going down as there's fewer gift cards out there that will compel us to provide goods or services. And sales revenue, well, revenue is definitely an income account and it increases net income. Okay. Be very careful about deferred revenue. It does say revenue, but this in itself is not an income account. It is associated, movements in this account are associated with revenues, but it itself is a liability.